Good day, students. Today we're talking about partnership liquidation. And these are our learning objectives. First, we will state the order of priorities in cases of liquidation. Second, we will account for the liquidation of a partnership. Now, when we talk about liquidation, this is the termination of business operations or the winding up of affairs of a business operation. It is a process by which the assets of the business are converted into cash, the liabilities of the business are settled, and any remaining amount is distributed to the owners. And these are some of the reasons or causes of a dissolution. First, you have bankruptcy of the firm. Second, mutual agreement among the partners to close the business. Third, the purpose of which the partnership or the business is formed is already accomplished. And then fourth, the period covered in the partnership contract has been terminated. So those are the some of the reasons or causes of partnership dissolution. And before we proceed to explaining what are the types of liquidation or how you do liquidation process, let us take a look at some terms related to partnership liquidation. First, we have the term realization. Realization, this is the process of converting non-cash asset into cash. Example is building. For example, again, a building is sold for cash, or your inventory are sold for cash. So that's a realization, the process of converting non-cash asset into cash. Second, you have gain on realization. When you say gain on realization, it means that the excess of the selling price or the proceeds from the sale of the non-cash asset over its book value. Example, if you will have a merchandise costing 20,000 and then you sold it at 25,000, so in that case, the proceeds are bigger than the cost. The excess of 5,000 is what you call as the gain on realization. Now, the third one, you have what you call as the loss on realization. So when you say loss on realization, the excess of book value of the non-cash asset over its selling price or proceeds. Going back to our previous example, now if you will have a merchandise costing 20,000 and then you sell it at 18,000 only, as you can see that the proceeds are smaller than the book value of the inventory or the merchandise inventory. Therefore, it was sold at a loss. So the 2,000 difference there is what you call as loss on realization. Then we have the term capital deficiency. So capital deficiency, this is the excess of a partner's share of realization loss over his capital credit. For example, if partner A has a capital credit balance of 30,000 and then his share of the realization loss is 33,000. So since his share of the realization loss is bigger than his capital credit, he has developed a capital deficiency in the amount of 3,000, or his account develops a debit balance. You call it as capital deficiency. Then we have the term deficient partner. Deficient partner, this is a partner who develops a debit balance in his capital account after his share of the realization loss. This means that his capital credit could not absorb his share of the realization loss. So using the previous example, if the partner is a deficient partner, which is a debit balance of 3,000, okay, then that's again a debit balance of 3,000. You call it as a deficient partner. Then we have what you call as a solvent partner. Solvent partner is a deficient partners. It means, again, a partner who has a debit balance, ayan, capital, but who is capable of paying to the other partners or the partnership is capital deficiency. It means a particular partner has assets or cash that can be paid, or that particular partner can pay its capital deficiency. It will act as additional investment on the part of the partner. So using the previous example, if the partner who has a debit balance can pay his capital deficiency, like if it is a 3,000 debit, then he can pay cash in the amount of 3,000. Then that partner is what we call as a solvent partner. Then you have insolvent partner. So an insolvent partner is a deficient partner who is not capable of paying his capital deficiency due to personal bankruptcy. Again, using the same example, if partner A, who has a debit balance after his share of the loss on realization, a debit balance in the amount of 3,000, and the partner cannot pay anymore his capital deficiency because, again, he or she has experienced personal bankruptcy, then we call it as an insolvent partner. Next, the term partner's loan. Partner's loan is the amount of money borrowed by the partnership from the partners. So it is the liability of the partnership to the partners extending the loan. Then the last term, we have right of offset. Right of offset is an established legal doctrine that a deficient partner can exercise to partly or fully apply his loan to the partnership against his capital deficiency in the process of liquidation. Now, with this particular term, we will have an example later on, but through an exercise wherein one of the partner will exercise this right of offset. Okay, to explain it further, we will just have this one later on the exercise. Now, to continue, these are the methods of liquidation. But for this particular discussion, we will not discuss installment liquidation. We'll just discuss lump sum liquidation. And then our example also will be based on lump sum liquidation. So these are the two methods of liquidation, lump sum liquidation and installment liquidation. For lump sum liquidation, the partner's claims are settled in a single lump sum payment after all non-cash assets are realized and after all liabilities are settled. By the word lump sum, we will assume that all of your assets are realized one time. Okay? So again, all non-cash assets are realized and after all liabilities are settled. The second method, which is installment liquidation, the partner's claims are settled on an installment basis as non-cash assets are realized and as cash becomes available, but only after all liabilities are fully settled. Now, for installment liquidation, by the word installment, it means that your non-cash assets are not realized one time. Okay? So it is on an installment basis. So that's installment liquidation. But for the purpose of our discussion, we'll focus on lump sum liquidation only. Okay? To continue, excuse me, I'll just stop sharing it for the moment. Again, to continue, let's have our next slide. Let's talk about settlement of claims. So the order of priority. Okay, so the available cash of the realized non-cash asset is used to settle claims in the following descending order. First, you pay outside creditors. Second, you pay the inside creditors, like loans to partners or payable to partners. And then the last one, third, to the partners or the owner's interest. So this is how we settle claims based on our available cash. Okay, so these are to explain how do you do lump sum as well as installment liquidation. These are the procedure. In a lump sum liquidation, all of the non-cash assets are converted into cash, and the total gain or loss on the sale is allocated to the partner's capital balance based on their profit or loss ratio. So it means whatever amount that the partner was able to convert its non-cash asset, if it is gain or if in case it will have a gain or loss on those realization, it will be divided according to their profit and loss ratio. And then the third one, actual liquidation expenses are allocated to the partners' capital balances, again based on their profit and loss ratio. On an installment basis, some of the non-cash assets are converted to cash. The carrying amount of any unsold non-cash asset is considered as a loss. So this is allocated to the partners' capital balances based on their profit or loss ratio. And actual and estimated future liquidation expenses are allocated to the partners' capital balances based on their profit or loss ratio. Okay, to continue, under lump sum liquidation method, liabilities to outside creditors are fully settled. So they are the first priority. And liabilities to inside creditors are fully settled. So payable to partners. And any remaining cash is distributed to the owners in full settlement of their interest. So that is how you do lump sum liquidation. Again, let's go back to the previous slide to explain it further. For lump sum liquidation, all of your non-cash assets are realized. Any gain or loss will be allocated to the partners based on their profit and loss ratio. And any actual liquidation expenses, again, will be distributed to the partners' capital account based on the profit and loss ratio. And the next thing you do is you pay your liabilities based on the order of priority. Pay first the outside creditors, and then pay the inside creditors like payable to partners or the partner's loan. And whatever cash is remaining, it will be distributed to the owners in full settlement of their interest. On the other side, if it is installment liquidation, the realization of the non-cash assets are done on an installment basis. So there are assets which are not yet sold or not yet realized. The assumption would be you will assume all those non-cash assets that is unsold to be considered as a loss. And this loss, again, is allocated to partners based on their capital balances. And any actual as well as estimated future liquidation expenses are again allocated to the partner's capital balance based on their profit and loss ratio. Liabilities to outside creditors are either partially or fully settled depending on the available cash. And liabilities to inside creditors are partially or fully settled, but only after full settlement of the liabilities to outside creditors. So you can pay the inside creditors or payable to partner or loans to partner or partner's loan if you have fully settled the outside creditors liability. Okay. And if both the liabilities to outside and inside creditors are fully settled, any remaining cash, less cash set aside for future liquidation expenses, is distributed to the owners as partial settlement of their interest. Okay. Now let's talk about marshaling of asset. Like, how do you apply or how do you distribute the cash available after you have settled your creditor? This time we'll talk about the solvent and the insolvent partners. Now, if a partner who is solvent, it shall be required to make additional contributions to settle any deficiency, okay, in his capital balance, subject to the following order of priority over his personal assets, like the partner's separate creditors, the partnership creditors, and to the owner and to the other partners by way of contribution. And if the capital or the capital deficiency of an insolvent partner shall be offset to the capital credit of the other partners. Again, if in case you have settled all our liabilities to outside creditors, and one of the partner will develop a capital deficiency, meaning his or her capital will have a debit balance. If that partner is solvent, that partner can make additional capital or contribution to settle the deficiency. But in the event that the partner is insolvent, then the capital deficiency shall be absorbed by the remaining partners. You call it shall be offset, shall be absorbed by the capital credit of the other partners who has not developed a capital deficiency. Okay, now let's apply the concepts that we have learned through this particular example. So let me share again my screen. So this particular exercise is taken out from our book. Okay, if you have the book with you, you can take a look at exercise 5-2. Okay, and the answers is here. I'll be sharing this to you in our LMS later on. Everything will be shared. So let's take a look at this problem first. Exercise 5-2. The partnership of Lucina Watin and Julian Veloso has come to an end. Upon their urgent request, the accountant prepares the statement of financial position as follows. So you have here its assets. The total is 200,000. The non-cash assets are inventories and furniture and fixtures. And then the liabilities and partners' equity. So you have 60,000 liabilities, loan coming from partner Watin, 40,000 the capital of Watin, and then 90,000 the capital of Veloso. And we have here the highlight that the non-cash asset were realized in the amount of 84,000. All non-cash assets are realized in the amount of 85,000. And the partners' profit and loss sharing was 60%, 40% respectively. Our requirement is to prepare a statement of partnership liquidation, assuming that first, Watin is solvent, partner Watin is solvent. Our second assumption is that partner Watin is an insolvent partner. And we provide journal entries to record the partnership liquidation under the two assumptions. Okay, so again, this is problem 5-2. If you have the book with you, you can refer it to your book. And the given are the following. The non-cash assets were realized for 85,000 only. It means your inventory and the furniture and fixtures, so the total of this is 180,000, were only realized for 85,000. Okay. Now let's take a look at first requirement, A1, that the partner Watin is solvent. So this is your statement of liquidation, statement of partnership liquidation. So for the balances, just copy the balances. For cash, that's 20,000. And then you group all non-cash, it's 180,000. Liability, that's 160,000. Watin loan, 10,000. Watin capital, 40,000. Veloso capital is 90,000. Now again, the non-cash asset realized for only 85,000. So you will add 85,000 to your cash. You will deduct 180,000 for the non-cash. The loss will be distributed 60% to Watin and 40% to Veloso. Okay. Loss is, we have a total of 95,000. So 57,000 will be deducted to the capital of Watin. 38,000 will be deducted to Veloso's capital. It will give us these particular balances. For cash, 105,000. Okay, liabilities is the same. And then partner's loan, Watin loan, and the capital balances of the partners. As you can see, Watin will develop a what you call as debit balance or a capital deficiency in the amount of 17,000. Veloso, you will have 52,000 as capital balance. Now, what partner Watin will do is to exercise her right of offset. As you can see, you have here a loan, but you will do that one later after you have paid your liabilities first to outside creditors. As you can see, we do have order of priorities. So first, we will pay outside creditor and then inside creditor. And the balance of your cash after paying all the liabilities, it will be given or distributed to the partners. So before we will exercise the right of offset, let us pay first our outside creditor. So this is payment of liabilities in the amount of 60,000. So you have here minus 60,000. So that's 45,000, the balance of our cash. Okay. Then our liabilities now is 0. What is left is Watin loan, Watin capital, which is debit balance, and Veloso capital. Now this time, Watin can now apply the right of offset. Again, when you say right of offset, this is an established doctrine or a legal doctrine that a deficient partner can exercise to partly or fully apply his loan to the partnership against his capital deficiency in the process of liquidation. So partner Watin will exercise the right of offset. So the 10,000 loan, it will be deducted here as liability and it will be added here as an additional investment or additional in his or in her capital. So after exercising the right of offset, still partner will have a capital deficiency in the amount of 7,000. But since our assumption here is that the partner is solvent, therefore, partner Watin can make additional investment in the form of cash in the amount of 7,000. Okay, to apply to her capital deficiency. So in this case, you have additional cash paid by Watin, 7,000. So that settles the capital of Watin. And the remaining cash balance, which is 52,000, it will be given to partner Veloso. Okay, that's our first assumption. Watin is solvent. Now let's proceed to our second assumption. Our second assumption is that Watin is insolvent. It means that Watin will have a capital deficiency, and then the remaining capital deficiency will be absorbed by the partner, since partner Watin is insolvent. We will follow the same procedure. So you have here the realization of your non-cash asset. It's a loss. It will be distributed to the partner based on their profit and loss ratio. Okay. And then you pay your outside creditors in the amount of 60,000. And again, Watin will have a capital deficiency. Veloso will have 52,000 capital balance. And Watin will exercise the right of offset in the amount of 10,000. So overall, Watin will have a capital deficiency of 7,000. Since Watin is insolvent, it will be absorbed by the remaining partner, which is Veloso. It will be deducted to Veloso's capital, 7,000. Okay. Therefore, Veloso will now have a capital balance of 45,000, same as the balance of the cash. Okay. And Watin capital will now be fully settled, no capital deficiency, after the deficiency was absorbed by partner Veloso. So this is the second requirement if the partner is insolvent. Partner Watin here is insolvent. Okay. And then requirement B, the journal entries to record the liquidation process. So first, journal entry. This is to record the sale of your non-cash asset. It will have the same entry, no, on the second requirement or the second assumption. So you will have a debit to cash, 85,000, a credit to non-cash asset in the amount of 180,000, and the loss on the realization will be debited to the partner's capital. Watin will share 57,000, and then Veloso 38,000. This is based on their profit and loss. Second entry, this is to recognize payment of your outside creditor. So you debit accounts payable, you credit cash. Same thing as in our second assumption, we'll have the same entry. And the third entry, entry C, this is to exercise the right of offset. So this will be your entry. You debit Watin loan, 10,000, and then you credit Watin capital, 10,000. Same here. Okay. For letter D, the first assumption is that the partner is solvent. Therefore, Watin will just pay cash for the capital deficiency. On the other hand, partner Veloso will absorb the capital deficiency of Watin. So these are your entries. Debit cash, 7,000, and then credit Watin capital, 7,000. If partner Watin is insolvent, again, it will be absorbed by Veloso. So you will debit Veloso capital, 7,000, and then you will credit Watin capital, 7,000. And ultimately, the cash balance will be paid to partner Veloso. So for the first assumption, debit Veloso capital, 52,000, credit cash, 52,000. Second assumption, partner Watin is insolvent. Debit Veloso capital, rather, 45,000, credit cash, 45,000. Okay, so this is again a sample exercise or problem 5-2, wherein one of the partner will have a deficient capital, and the assumptions such as the partner is solvent and the partner is insolvent, as well as exercising the right of offset. Now we do have another example. It's on exercise, or this is exercise 5-4. You can take a look at your book for this particular exercise. Still lump sum liquidation. the partnership of Puzon, Celesana, Antique, and Cebu Convenience Store, in which partners share profit on the ratio of 30%, 30%, 40%, and appeared as follows. So these are the asset of the partners and liabilities and equity. As you can see, the non-cash asset here are 57,000 and 70,000. On this date, the partners decided to liquidate the business. So in January 20C, 50,000 was collected from the customer's account, after which the partners have agreed to write off the balance, including the valuation account, by charging to the respective capital accounts. The merchandise was realized towards the month end at 85% of its realizable value, and at the end of January 20C, the liquidation process is over. So as you can see here, you have here 50,000 for the realization of your receivable, and the remaining merchandise, the non-cash asset, 85% realized. So we have here our solution to this particular problem, 5-3. This is the requirement. Prepare a statement of partnership liquidation and provide for the journal entries. Okay, so this is our partnership liquidation. So again, balances taken from the statement of financial position, cash, the non-cash, accounts payable, Puzon loan, Puzon capital, Celesana capital, and then you have Teki capital in the amount of 35,000. The first realization of your asset is your accounts receivable. It was realized for 50,000, but the receivable, the value is 57,000. So you will have a 7,000 loss. It will be divided to the partners according to their profit and loss ratio. So the share would be 2,100 will be deducted to Puzon and Celesana capital, and 2,800 will be deducted to Tiki capital. The second non-cash asset, the merchandise, it was realized for 59,500, but the value is 70,000. Again, you will have a loss in the amount of 10,500, and it will be distributed based on their P&L ratio. So that's 3,150 to Puzon, and then 3,150 to Celesana, 4,200 to Teki. The next thing we do is that we will pay our outside creditors. So you will have 62,000. You pay your outside creditors. And then you pay the inside creditor. Now, as you can see in this particular example, since partner Puzon, okay, does not develop a capital deficiency, therefore, you will pay it to Puzon as is. You will not exercise the right of offset. Okay, so you pay payment to loan or payment to partner, which is Puzon loan in the amount of 5,000. So the remaining cash, which is 87,500, it will be paid to the partners. You have 29,750 to Puzon, 29,750 to Celesana, and 28,000 to Teki. Okay. Then your journal entries. Okay, for a while. Okay, for the journal entries on the second requirement, you have here the accounts. First, this is to realize your receivable. Take note, all the remaining balances is write-off or is written off by the partners as agreed. So 3,000, that's is written off. Allowance for doubtful account, so you debit the account. And then the realized amount, 50,000, you debit that to cash. And the loss will be distributed or will be deducted to the capital of the partners. So you have here debit Poson capital, Celisana capital, Teki capital. And the second one, this is the realization of your merchandise. Again, this is a loss. You have a loss in the amount of 10,500. Sorry, it should be 59,500. Okay, this should be 59,500. Debit to cash, and then credit to Poson capital, 3,150, Celisana capital, 3,150, Teki capital, 4,200. Let me just change this one. It should be 59,500. Okay. And then you pay the outside creditors, the third entry. You debit accounts payable, you credit cash. And you pay the inside creditor, you pay partner's loan. Debit Poson loan, 5,000, credit cash, 5,000. And ultimately, you distribute the remaining cash to the partners. Okay, to complete the liquidation process. So these are the cash given to Poson, Celisana, as well as Teki. Now, I do have here another example, 5-4. You can look into this one. I will share this to you later on. It's the same problem or same nature of problem, lump sum liquidation. This is 5-4. Just take a look at the background of the problem in your book, or I will share it to you later. This is your solution for that particular problem. The requirement here is to prepare a statement of liquidation and also a journal entries related to the liquidation. So for now, that would be all. I do hope you have understand the liquidation process, lump sum liquidation to be specific. So thank you for your time. And if you have any question, feel free to chat me or ask questions.